This video is created by Jagrat Creations. It is on investment accounts, hence useful to the students who are reading for CA Intermediate, ICWAI Executive, BCom or say CA-IPCC. I want to solve one sum on investment accounts. Just observe the sum on the screen. This is the sum that I intend to solve. I read the sum for you. From the following information, prepare 12% Government of India's loan account and pass necessary journal entries in the books of Shri Salman. Opening balance as on 1/4/2015. Face value of the loan means investment 2 lakhs. Cost price of loan 2,10,000. Accrued interest 6,000. Date of payment of interest is 31st of December and 30th June every year. Transactions during the year 1st of May 2015. Cum-interest purchase 50,000 face value, price 96. On 1st of June 2015, face value of investment purchase 20,000, price is 98, ex-interest price. On 1/8/2015, cum-interest sale, so 80,000 face value of the investments means loan is being sold. And on 1st of March, 1,10,000 ex-interest sales. Value the closing balance of investment. The valuation of the closing balance of investment is to be made as per FIFO method. Now this is the details given to you for the purpose of preparing investment account. We are also required to write down the journal entry. Now here there are, so far as investment is concerned, there is an opening balance of investment account, face value 2 lakhs, cost price 2,10,000. There are 2 purchase transactions, there are 2 sales transactions. Investment is an asset. Asset account is debited when asset comes in our ownership. So when the investments are purchased, investment account is to be debited. So for this first 2 transactions, investments are purchased, so investment account gets debited. Every asset has got a debit balance, so this opening balance of investment account, this investment account opening balance will be recorded on the debit side. So on the debit side of investment account, opening balance will be recorded. These 2 purchase transactions also will be debited to investment account, and there are 2 sales transactions. When the asset goes out of your ownership, the asset account gets credited, so these 2 sales transactions will be credited to investment account. So opening balance, 2 purchase transactions are going to be debited, then 2 sales transactions are going to be credited. After that we shall find out the closing balance. Now see, the investment account is to be prepared to find out the profit or loss on sale of investment. So the purpose of this investment account is to find out the profit or loss as to investment transactions. So when we are required to find out the profit or loss, by preparing this investment account, all the purchase of investment will be debited to the investment account at cost, and all sales of investments will be recorded to the credit side of investment account at its net sales value. So purchases will be recorded at cost, sales will be recorded at sales value. The difference between purchase value and sales value may be identified as profit or loss, and we intend to find out such profit or loss by preparing this investment account. So whatever the concepts that I have told to you so far, Opening balance of investment will be recorded at cost. Purchases will be debited to the investment account at cost. Sales of investment will be recorded at sales value of the investment. The closing balance of investment will be valued as per FIFO method. So first in, first out method. So investment purchased first are sold first. Investment purchased next are sold next. That is the implication of FIFO method. So valuation of the closing balance of investment is to be made on FIFO method. Let me explain. I had an opening balance face value of investment 2 lakhs. So face value opening balance is 2 lakhs. Then 50,000 face value is purchased. Then 20,000 face value is purchased. So now I have got the investment of 2 lakhs plus 50,000 plus 20,000. 2,70,000 are the investment that I hold. Out of this 2,70,000, the first sales takes place 80,000. Face value of 80,000 investments are sold. So this 80,000 are sold will be considered as sales from opening balance 2 lakhs. So opening balance 2 lakh face value, out of that 80,000 are sold because first entry is of 2 lakhs, next entry is of 50,000, then next entry is of 20,000, then first exit 80,000. So first exit will be from the first entry. So from 2 lakhs 80,000 will be sold. Now out of 2 lakh 80,000 is sold. The investment left with me are 1,20,000 which has entered first. Out of that 1,10,000 will be sold. So first in first out method. So 2 lakh face value investment are first in. From that first out 80,000 will take place. Next out 1,10,000 also will be take place from it. And out of this 2 lakh 1,90,000 face value investments are sold. So investment left with us, the face value of which will be 10,000. Its cost will be found out. So here 2 lakhs face value cost is 2,10,000. How much is the cost of 10,000 face value? So we can find out the cost of 10,000 investment. To that, the purchase cost of this 50,000 and 20,000 will be added. So I will get the closing balance of investment by first in first out method. By comparing the credit side and debit side of investment account cost column, I'll find out the profit or loss on sale of investment. If there is a profit, it will be transferred to the credit side of profit and loss account. If there is a loss, it will be debited to profit and loss account. This is how I intend to prepare investment account. Now another important point that one should understand, that investment fetch interest. So I should account for interest simultaneously with investment accounting. Now I want to focus on interest accounting. On investment, the interests are received. Interest received is an income. Interest received will be credited to interest account, and the annual net interest income of this investment will be transferred to interest and dividend account at the end of the year. This is the normal philosophy for accounting for interest. Now, the next important point that I want to bring to your notice, that on this investment, the date of payment of interest is 31st of December and 30th June. So, we get interest on the face value of investment. We get interest on the face value of investment on the interest date. So, we receive interest on 30th June. We receive interest on 31st of December. On 30th June, we receive the interest for 6 months. On 31st of December, we receive interest for 6 months. So half yearly interest is received on 30th June and 31st of December on this investment. Who will receive interest? 6 months interest is paid by the loan. By this government loan administrator, the interest is paid on 30th June and 31st of December. I, being an investor, I will receive that interest on 31st of December and 30th June, right? The interest will be calculated at the rate of 12% on the face value. That is also fine. But I will receive interest on the face value of investment held by me. So if I have sold the investment in between these two dates of interest, I will not receive the interest on the interest date because I am not the holder of this investment. So if the investment are sold in between these two dates, suppose that I sold the investment on say 1st of August. So 1st of August is a day between 30th June and 31st of December. So on 1st of August I have sold this investment 80,000. So I will not receive the interest on this 80,000 on the next interest date because I have sold them. Who will receive interest on this 80,000 investment sold? The interest will be received by the purchaser. The purchaser will receive interest for the 6 months. But if you notice that I have sold investment on 1st of July, last interest was paid on 30th June. So I have received interest. Last interest was paid on 30th June. Now these investments are sold on 1st of August. So last interest was received on 30th June. In the month of July, my amount was invested, my 80,000 face value investment. My investment were with me for 1 month. For 1 month, I should get the interest. As I have sold this investment, the interest on investment will be received by the purchaser, and that too he will receive for 6 months. Out of that 6 months, I am the holder of this investment for 1 month. So I should get the interest for 1 month and the purchaser should get the interest for 5 months. This is how interest should be accounted for. So when I sell this investment, 80,000 face value investments are sold. Cum interest. Cum interest means I will collect, while selling this 80,000 investment, I will collect not only the sales value of the investment, but I will charge interest for 1 month. So this 103 is a cum interest price. So I am going to sell this 80,000 investment at the rate of 103 per investment. So 100 face value investment is sold for 103. This 103 is a value is with interest. With interest value is 103. Okay, how much is the sales value? How much is the interest element? Last interest was received up to 30th June. It has been sold on 1st of August. So only July is a 1 month for which I am entitled to have an interest. And 1 month interest on 100 rupees at the rate of 12%. On 100 rupees, 12 months interest is 12 rupees. So 1 month interest is 1 rupee. I have received interest on this investment up to 30th June. In the month of July, after the month of July, I have sold them. I am entitled to have an interest of 1 month. 1 month interest will be 1 rupee. And that 1 rupee is the interest element, is a part of 103. That's why this 103 is known as cum interest sales price. So cum interest price means price that includes interest. So this 103 is the price which includes interest element 1 rupee and 102 is the sales value. This is the meaning of cum interest. But when you are given the price X interest, so 104 is the sales value X interest. So this 104 is a price that do not include the interest element. So when this amount doesn't have the interest element, this 104 is an amount without interest element. Do you mean to say that the interest is not going to be exchanged? This sales has taken place on 1st of March. When the last interest was received? Last interest was received on 30th June. So 30th June, last interest was received. See, interest dates are 30th June and 31st of December. This is 1st of March. So last interest was received not on 30th June, it was received on 31st of December. So we have received interest up to 31st of December. So January and February are the 2 months for which we are entitled to have interest. So 2 months interest per 100 rupee will be rupees 2. So when I will sell, not only I will get 104 rupees per one face value security, I am going to get the interest element of rupees 2 over and above this 104. That is the meanings of X interest sales. Similarly, if I want to explain the cum-interest purchase, I have purchased one loan face value 100 at a price of 96. This is cum-interest price. So this 96 includes interest element. How much is the interest element? The interest element included in 96 is right from the last date of interest when the interest was received till the date of transaction. So on 1st of May, the last date of interest was 31st of December. So how many months have gone thereafter? 4 months. So 4 months interest, 4 rupees is a part of this 96. So 96 is a price, cum-interest price, which includes 4 rupees interest element. In brief, I am going to consider all these points while solving the sum in more detail. But in brief, cum-interest price means price which includes interest element. X-interest price means price without interest element. Now the price is given cum-interest or X-interest, whatever it may be, the interest exchange takes place. The interest exchange takes place. The interest calculated for such exchange is for which period? That period is from last date of interest till the date of transaction. Now how the interest is exchanged? When I purchase the security, I am required to pay this interest. When I sell the security, I get that interest. Once again, in case of investment, purchase and sales transaction, interest element is to be accounted for. May it be a cum-interest purchase price or sales price, may it be a X-interest purchase price or sales price. Interest is going to be exchanged. For which period? From last date of interest till the date of transaction, interest. For that period, interest exchange takes place. Now we are required to calculate the interest for that period. If that interest is a part of price, then it is known as cum-interest price. If that interest is not becoming a part of the price, then it is known as X-interest price. Even if it is a cum-interest or X-interest, interest exchange takes place. For which period? From the last date of interest till the date of transaction. That period interest exchange takes place. How interest exchange takes place? If I purchase the security, if I purchase the investment, I pay the interest for that period. But if I sell the security, I get the interest for that period. The period that I have explained, that is last date of interest till the date of transaction. Now at the time of purchase, the interest that I have paid, that I will recover on the next interest date. The interest that I have paid at the time of purchase of security, that interest will be recovered by me on the next date of interest. Say for example on 1st of May 2015, I have purchased. Last interest date was 31st of December. 31st December to 1st May, 4 months. 4 months interest is 4 rupees. If I purchase one loan, face value 100, I am required to pay 4 rupees interest. This 96 is a price, is cum-interest. So this 96 includes 4 rupees interest element. So my net purchase price is 96 minus 4, 92. So 92 is the cost of purchase price. 4 rupees is the interest element that I am supposed to pay at the time of purchase of investment. Now the 4 rupees paid, I'll get that 4 rupees back on the next interest date, that is on 30th June. On 30th June, I will receive interest at the rate of 12% for 6 months. 6 rupees interest I am going to receive. So I'll pay interest rupees 4 on 1st of May. I am going to receive interest of rupees 6 on 30th June. So my investment holding period is 2 months. From 1st of May to 30th June, 2 months. 2 months interest is rupees 2 that I am going to get. But how am I going to get? I am required to pay rupees 4 at the time of purchase. I am going to get rupees 6 on the date of interest. So 6 is the receipt and 4 is the payment. Net income is 2 rupees. This is how interest is accounted for. Now this is cum-interest, X-interest, FIFO, investment accounting. Purchases are debited, sales are credited. Purchases are debited to investment account at the purchase price. Sales are recorded to the investment account at the net sales value. All these concepts I have discussed. After this, I want to give you the steps for the purpose of solving the sum. Now observe the steps for the solving the sum. First of all, write the opening balance on debit side of investment account. Write opening balance on debit side of investment account. Now, accounting period is from 1/4/2015 to 31/3/2016. I am given the opening balance as on 1/4/2015. So accounting year ends on 31st of March 2016. So I am required to go for accounting for 1 year, 15/16. Here I am going to prepare an investment account. On the debit side of investment account, I am going to write down the opening balance of investment, that cost price 2,10,000. In face value column, that's a memoranda column, pro forma column, in which I am going to record the face value 2 lakhs, and in cost column, I will record 2,10,000. Now, the interest payment as given to you in the sum is 30th June and 31st of December every year. This is the interest payment date. I write opening balance on 1/4/2015. Opening balance is recorded on 1st of April. The last interest on this investment of 2 lakhs was received on what date? On 31st of December. So last interest was received on 31st of December 2015. Today it's 1st of April 2015. So from 31st of December 2015 to 1/4/2015, 3 months have passed. This 3 months is a period of last accounting year, and in this 3 months, the interest was due. Interest has accrued. Interest has accrued, and that accrued interest will be received on 30th June. Next, on 30th June 2015, I am going to receive interest for 6 months. But out of this 6 months interest, 3 months interest pertains to the previous year. That is identified as accrued interest at the beginning of the year. And that accrued interest is transferred to interest account at the beginning of the year. So, interest accrued on 1/4/2015 is for 3 months. So, on 2 lakhs at the rate of 12%, for 3 months, interest has already accrued, and that will be transferred to interest account at the beginning of the year. Now, after recording this opening balance and adjustment entry for interest accrued, start recording transactions. Now, which transactions are recorded? Record the transactions that are entered into before the next date of interest. Now, next date of interest is 30th June. How many transactions are entered into before 30th June? 1st of May 2015, purchase transaction. 1/6/2015, purchase transaction. These two transactions are entered into before next date of interest, that is 30th June. So before 30th June, these two transactions are entered into. Record these transactions. After recording these transactions, how these transactions will be recorded, that I'll show you after a couple of minutes. But after recording this transaction, record the interest received on the face value of the investment held on interest date for a total period between two interest dates. So after recording these two transactions, write the entry for interest received for 6 months. That is the third transaction. Now, after recording this interest once again, record transaction till the next date of interest or end of the accounting period, whichever is earlier. Now, 30th June interest is already recorded. Next interest date is what? 31st of December 2015, and accounting period ends on 31st of March 2016. So which is prior? 31st of December 2015 is a prior date. So record the transaction till 31st of December 2015. The transaction till 31st of December 2015 is the sales. On 1/8/2015, 80,000 face value sold. This transaction will be recorded after receiving interest as on 30th June. Because this transaction has occurred before 31st of December, that is next interest date. After recording this third transaction, I will write the entry for interest received. Record the interest received on the face value of the investment held on the interest date for the total period between two interest dates. So I will record a transaction for interest received on 31st of December. Understand one thing I repeat. Once again I repeat. Write opening balance on 1/4/2015. Next interest date is 30th June. Record the transaction. Record all the transactions that are entered into before 30th June. These two transactions are entered into before 30th June. 1st of May and 1st of June. Then record the transaction for interest received on 30th June. Then three things are over. First, opening balance interest accrued done. Second, these two transactions. Third, I have received interest. Then record transactions that are entered into before next interest date, that is 31st of December. So this transaction will be recorded next. After that, I will record the entry for interest received on 31st of December, that for 6 months. Then once again record. So record the interest received on the face value of the investment. So on 31st of December, I am going to receive interest. That transaction will be recorded. Then once again, record the transaction till the next date of interest or end of the accounting. Now next date of interest is 30th June. Before that, accounting period ends on 31st of March. So record all the transactions before 31st of March. So that transaction of 1st of March 2016, that will be recorded after that. So this is the accounting period ends on 31st of March. Transaction entered into before 31st of March, but after 31st of December is on 1st of March 2016. That will be recorded. After recording this transaction at the end of the year, find the closing balance for the value of investment held. Write the interest. Write the entry for interest accrued. So on 31st of March, the interest accrued will be recorded for 3 months because last interest was received on 31st of December. Now this is 31st of March. Accounting period ends on 31st of March. So 3 months have passed from last date of interest. So interest accrued gets recorded at the end of the year. Write the entry for interest accrued. Then value the investment as per the accounting norms. Here you are told that the value investment as per FIFO method. So valuation of investment will be made on the basis of FIFO method. After recording these things, close investment account and find the profit or loss on sale of investment and transfer it to profit and loss account. And last, interest account is to be closed. Close interest account and transfer the net interest received to interest and discount account. These are the steps that you are required to follow for the purpose of solving the sum. So this is a sum wherein I want to discuss theory as well as I want to apply this theory to the practical problem that I have taken. So that's why I have given you these steps for the purpose of solving the sum. Now I want to start with the solution of the sum. This is the details given to me in the sum. These are the transactions that I intend to record. I am required to prepare government loan account. Here I am going to prepare investment account and interest account. There will be one more column for face value, which is a memoranda column. This is the debit side, this is the credit side. Now I should write down the date of interest at the title. So this is my debit side, this is my credit side. Interest is payable on this loan on 31st of and 30th June every year. Now I want to start with the sum as per the steps prescribed. Here I am going to write down the steps for you. Write the opening balance on the debit side of investment account. Face value will be recorded in the face value column. Beginning of the year 1/4/2015, end of the year 31st of March 2016. So face value 2 lakhs opening balance. Cost price of the loan is 2,10,000, that will go in the cost column. This interest accrued, for which I am required to write the adjustment entry. The opening balance is recorded on 1/4/2015. Last date when the interest was received was 31st of December. 2014. So from 31st of December 2014 to 1/4/2015, 3 months. These 3 months are of the last accounting period. In this 3 month, interest has accrued, which is to be received on next 30th June. So this accrued interest will be transferred to the debit side of interest account. So the adjustment entry for that will be recorded. Interest account debit to accrued interest account credit. So I will write on the debit side of interest account, accrued interest 6,000. This interest will be received on 30th June next. So first I wrote the opening balance. Then I wrote the adjustment entry for accrued interest that is debited to interest account. So this is how the first step and the accrued interest adjustment is being over. After this gets over, the next step is to write down the transaction till the next date of interest. Now this is 1st of April 2015, next date of interest is 30th June 2015. Whatever the transactions that are entered into between 1st of April 2015 to 30th June 2015 will be recorded, and this transaction or these two transactions, purchase transaction, has occurred before 30th June. So record the transaction before the next date of interest, that is 30th June. I want to record this first transaction, purchase government loan of 50,000 face value. Price given to me 96. This is cum-interest price. So this 96 price is a price with interest. How much is the interest is there? The interest is for a period from the last date of interest till the date of transaction. Last date of interest was 31st of December 2014. This is 1st of May 2015. So number of months are 4. Now 12% is the interest rate. So annual interest is 12 rupees. Per month interest is 1 rupee. 4 months interest is 4 rupees. So this 96 includes 4 rupees interest element. So let me prepare a working. The purchases are debited to the investment account. So total payment made with interest 50,000 into 96%. This is the total payment made, which includes interest and the cost of purchase of investment. Let me find out the interest element therein. So interest element is for 4 months, 50,000 into 12% for 4 months. 4 months, 4 rupee is the interest per month. And that too on a security of 500 into 4. So 2,000 is the interest paid in this 48,000. So per cost of investment is 46,000. This is the transaction. What is the journal entry? Investment account debit, interest account debit to bank account credit. So 12% government loan account debit, interest on investment account debit to bank account credit. So I will write on the debit side of investment account and interest account. 2,000 interest account debit to bank account, government loan account debit to bank account. This is how journal entry gets recorded and the ledger posting is completed. After recording this purchase transaction, I am required to write down the next transaction because it is entered into before 30th June next, that is the interest date. So on 1/6/2015, face value 20,000, purchase price is 98 x interest. This is a price which includes only cost, but the interest element is not there. X interest without interest price. So if the investments are purchased X interest, that means we are required to pay the cost of investment at the rate of 98 per 100 rupee loan. But over and above, we are required to pay interest. Remember that interest is paid at the time of purchase of investment and interest is received at the time of sale of investment. That interest is received or paid. Interest is paid in case of purchase, that is paid for which period? From the last date of interest till the date of transaction. So here in this purchase transaction, over and above this 98, we are required to pay interest for a period that starts from last date of interest till the date of transaction. So here 20,000 investment account is debited. Last date of interest 31st of December 2014 to 1/6/2015. That is 5 months. Now cost of purchase is 20,000 into 98% plus you are required to pay interest for 5 months, that is 1,000. So 19,600 plus 1,000, 20,600 is the amount to be paid at the time of purchase of investment. That is with interest amount. So the journal entry for that, 12% government loan account debit, interest on investment account debit to bank account credit. So I will write on the debit side, cost of purchase of investment, interest is debited in the interest column. This is how this purchase transaction gets recorded. After recording this purchase transaction, I am required to write down the entry for interest received on 30th June. That is the next step. Record interest received on the face value of investment held on the interest date for the total period between two interest dates. So I am going to get interest for 6 months on the total investments held by me. Total investments held by me is 2 lakh plus 50,000 plus 20,000. So on 2 lakh 70,000, I am going to receive interest at the rate of 12% for 6 months. That is from 31st of December 2014 to 30th June 2015. So if you calculate interest on 2 lakh 17,000 for 6 months, that works out to be 16,200. Bank account debit to interest account credit. So interest account is to be credited for that. Now this 16,200 interest received, that includes the interest paid. So 6 plus 2 plus 1, 9,000 is the interest paid. That is made of what? Accrued interest for the past accounting period, interest paid at the time of purchase of investment. All this interest are received, recovered on the interest date. So 16,200 means recovery of this 9,000. Now this is how this fourth step is considered. Now next, record transaction till the next date of interest or the end of the accounting period, whichever is earlier. Now next date of interest is 31st of December. Accounting period ends on 31st of March 2016. Next interest date is 31st December 2015. Whichever is earlier, because 31st December 2015 is earlier. So record all the transaction between 30th June to 31st of December. That transaction, that is this 80,000, that is a sales transaction, cum-interest sales transaction, that I will record. Now see, sales, investments are sold, credit what goes out, so investment account is to be credited. In face value column, I write 80,000. Now this is a cum-interest sales price. So this 103 includes interest element. Interest for which period? From last date of interest till the date of transaction. Last date of interest was 30th June. This is 1st of August. So July is a 1 month for which interest exchange takes place. When I sell, I receive interest. So 30th June to 1/8/2000, 1 month. This is a price with interest. Cum-interest means with interest. How much is the interest element for 1 month? So 80,000 into 12% into 1 month. So this is the interest element. So this is the net sales value. Net sales value will be credited in this cost column. This interest will be credited in interest column. The journal entry for that is bank account debit 82,400 to 12% government loan account credit to interest account credit. This is how transaction gets recorded. So this is our sales, cash is received, bank account debit, interest received is to be credited to interest account, and the sales value of the investment is recorded in this cost column. So this is how 81,600 is recorded. Now this transaction is already recorded with journal entry. Now I will record the entry for interest that has been received on 31st of December. So on 31st of December, record the interest received on the face value of the investment held on the interest date for the total period between two interest dates. So 30th June 2015, 6 months interest will be received. So 6 months interest will be received on the security hold. So 2,70,000 minus 80,000. 2,70,000 minus 80,000. So it will be 1,90,000 at the rate of 12% for 6 months. This is the interest received. Bank account debit to interest account credit. So interest account is credited for that. This is how interest entry recorded on the date of interest. And for which period? The interest entry, interest received entry is recorded is for a period between two interest dates. Now next, record all the transaction till the next date of interest or end of the accounting period. Now on 31st of December we have received interest. Next date of interest is 30th June. But the accounting period ends on 31st of March. So period that ends 31st of March 2016 is a prior period, then 30th June, that is the next date of interest. So we are required to record all the transaction till the end of the accounting period. And that transaction is of 1st of March. So 1st of March, X interest sales. Sales are credited to investment account. So 1,10,000 is the face value of the investment sold. 104 is the sales value per 100. So 110 into 104%, that is the sales value. This is the X interest price, X interest sales. So when we sell, we get the interest. We get interest for which period? From last interest date till the date of transaction. Date of transaction is 1st of March. Last date of interest was how much? 31st of December. So 31st of December to 1/3/2000, 2 months interest will be exchanged. So 2 months interest that I am going to receive 1200. So this is the X interest sales value. This is the interest that I am going to receive. Bank account debit 1,16,600 to investment 12% government loan account credit 1,14,400 to interest account credit. Both this will be credited here in the interest column and cost column. This is how sales transaction is recorded. Now, after recording all these things, I should strike the closing balance. I should write the adjustment entry for accrued interest. I should also find out the profit or loss on sale of investment and the amount of interest income to be transferred to interest and dividend account. All these things now I am required to find out and record. So next, find the closing balance of investment and interest accrued. So 2,70,000 minus 1,90,000. 2,70,000 minus 1,90,000. So 80,000 is the face value closing balance. So 80,000 is the balance of investment. Now on this 80,000, what is the cost of it? That I will find out by FIFO method. But I should write the entry for interest accrued. So on 80,000, on 31st October 2016, interest is accrued for 3 months. That is from last date of interest till the end of the accounting period. So 31st of December 2015 to 31st of 2016, 3 months interest is accrued. So here 80,000 into 12% interest accrued. Interest accrued amount is recoverable, is type of current asset. Interest accrued account debit to interest account credit, that is the journal entry. So interest account is to be credited with interest accrued. This is how adjustment entry for interest accrued is recorded, and this entry is reversed at the beginning of the next year. Now find the value of investment as per accounting norms. The method to be followed is first in, first out. That I already explained to you while introducing you to the sum. First in, first out. 2 lakh, first in. See, look at my style of presentation. Valuation of closing balance of investment is to be made on FIFO method. So to explain, I will just remove these columns for a while. 2 lakhs, 2,10,000. This is the first in. Out of that, say I have removed all this, the face value, 2 lakhs, 80,000, first in, first out. So from 2 lakhs, 80,000 is already issued, already sold. So the balance left with me after this is 1,20,000. So this is nil. So it has 2 lakhs minus 80,000. It has become 1,20,000. From this 1,20,000 next out 1,10,000. So 1,10,000 are given. So here the balance left is 10,000. So from 2 lakh, 70,000 and 1,10,000. From 2 lakhs, 1,10,000 and 70,000 are deducted. So 120 minus 110, though investment left are 10,000. So out of 2 lakh, 10,000 are the face value of the investment left. So 2 lakh, cost is 2 lakh 10,000. How much for 10,000? So that is works out to be 10,500. Now I bring all the details that I have removed. Next purchase is added 46,000. Next purchase is added 19,600. So this is the cost of investment by FIFO method. That is 80,000 face value. Its cost is 17,100. Remember one thing. So this is the original sum that I got from 2 lakhs. First out 80,000, 120 left. From 120, 110 given, 10,000 left. I have found out the cost of 10,000. 2 lakh face value cost is 2 lakh 10,000. How much for 10,000? I got the cost. To that I have added the subsequent purchases. So I will get the total cost of 80,000. So 10,000 plus 50 plus 20, 80,000. 80,000 cost is 76,100. Now close investment account and interest account. So total of credit minus total of debit, that is the net interest income. That net interest income will be transferred to interest and dividend account in this fashion. 24,000 is the income for the current year that will be transferred to interest and dividend account. So entry for that interest account debit to interest and discount account credit or interest and dividend account credit. And here total of debit minus total of credit. So there is a loss on sale of investment. This loss is debited to profit and loss account. So 3,500 is the loss debited to profit and loss account. So profit and loss account debit 3,500 to 12% Government of India loan account credit 3,500. This is our loss entry gets recorded. Now, while solving the sum, I have recorded all these journal entries that I want to demonstrate at one place. So these are the various entries that I have recorded, including transfer to profit and loss account. This is how this entire sum gets solved. I have tried to explain you this sum. I feel that you have followed. Thanks to you.